Before we begin, if you want to understand what's really coming, not what headlines want you to believe, if you want to see the patterns before they become disasters, then like this video, subscribe to Financial Insights, and stay with us. Because what you're about to hear is not comfortable, but it is necessary. February 12th, 2025. At exactly 1:02 p.m. Eastern Time, a Treasury market imbalance flashed across institutional terminals. It wasn't a crash. It wasn't a headline. It wasn't even reported on the evening news. But it shouldn't have happened. A routine government debt operation quietly failed to attract organic demand at prevailing yields. Primary dealers stepped in, again, absorbing risk they were never designed to carry long-term. The spread between real yields and inflation expectations widened past a level that, according to Federal Reserve research published years ago, signaled structural instability. No alarm sounded, no emergency statements were made, and that's how you know it's serious. Because real financial crises don't begin with panic. They begin with silence. You didn't feel it immediately, but the system did. That moment told us something chilling. The inflation fight was never being won. It was being postponed. And postponement is how every historical monetary collapse begins. You are not early. You are inside the event. Most people still think inflation is something that might come back. That belief alone tells you how little the public understands about where we are in the cycle. Inflation doesn't return after this stage. It embeds. It mutates. It hides inside structures. And by 2025, it is no longer an economic issue. It is a systemic one. What you are living through right now is not the aftermath of a pandemic or a war or supply chain disruptions. Those were catalysts, not causes. The cause is older, deeper, and far more dangerous. To understand it, you must go back to the last time the world tried to outrun monetary reality. Historical flashback. The decision that changed everything, August 15, 1971. A Sunday night address. A calm voice. A historic lie. The United States announced the temporary suspension of gold convertibility. Temporary, controlled, necessary. Those words mattered, because what actually happened that night was not policy adjustment. It was the removal of discipline from the global monetary system. For the first time in modern history, money was no longer constrained by anything real. No metal, no reserve requirement, no physical limit, only confidence. And confidence is not infinite. The 1970s did not erupt overnight. Inflation didn't immediately explode. In fact, the early years looked manageable, just like today. Officials blamed external shocks, energy, geopolitics, bad luck. But beneath the surface, something irreversible had begun. Money supply expanded faster than production. Debt grew faster than income. Claims multiplied faster than physical goods. And prices started whispering the truth. The lie of temporary inflation. By 1973, inflation was officially concerning. By 1975, it was persistent. By 1977, it was structural. By 1979, it was out of control. Sound familiar? Each stage came with reassurances. Each stage came with delays. Each stage came with political pressure to avoid pain, and every delay made the eventual correction more violent. The 1970s taught a brutal lesson. Once inflation becomes embedded into expectations, it stops responding to polite policy tools. It demands sacrifice. Back then, that sacrifice came in the form of interest rates so high they crushed entire industries and wiped out generations of purchasing power. Today, that solution is no longer available, and that is where the real danger begins. The Hunt brothers, when reality broke through. In 1980, silver exposed the system, not because it was rare, not because of speculation, but because physical demand collided with paper leverage. For years, futures markets had created the illusion of abundance. Contracts were traded, rolled, offset, all without delivery. Price was controlled through paper supply, not metal, until someone demanded the metal. The Hunt brothers didn't break the system, they revealed it. When delivery pressure mounted, prices didn't rise smoothly. They exploded. And when authorities stepped in, they didn't fix the imbalance. They changed the rules, position limits, margin hikes, forced liquidations. The message was clear. Price discovery would be allowed only as long as it didn't threaten the structure. That lesson was absorbed quietly by institutions, and the structure grew. The architecture of delay. Instead of correcting the flaw, the financial system doubled down on abstraction. Derivatives expanded. Futures volumes exploded. ETFs promised exposure without ownership. Leverage became normalized. Every real asset gained a paper shadow, sometimes dozens of them. Gold, silver, oil, food, even volatility itself. On paper, supply became endless. In reality, nothing changed. This system works beautifully during stability. It suppresses price signals. It smooths volatility. It creates the illusion of control, but it carries a fatal flaw. It assumes no one will ask for delivery all at once. The 1970s showed what happens when that assumption fails. And now in 2025, the conditions are far more extreme. The bridge to the present, after 2008, the system crossed another line. Central banks learned they could create liquidity without immediate consequences, or so it seemed. Balance sheets ballooned, rates collapsed, debt exploded. Inflation didn't appear right away. That absence created arrogance. By the time inflation finally surged, the system was already addicted to cheap money. Tightening became politically dangerous. Debt servicing became fragile. So the response was managed restraint, not resolution. Raise rates just enough to calm headlines. Pause before breaking something important. Promise future discipline. But inflation does not care about promises. It only responds to mathematics. And the math in 2025 looks eerily familiar to 1977. Not 1982. Why this time is worse. In the 1970s, total debt relative to GDP was manageable. Today it is suffocating. In the 1970s, globalization was expanding supply. Today it is fragmenting. In the 1970s, demographics supported growth. Today they strain it. And most importantly, in the 1970s, central banks still had credibility. In 2025, that credibility is thinning. When markets sense that inflation is being tolerated rather than defeated, behavior changes, contracts adjust, prices harden, trust erodes, and once that shift happens, it does not reverse easily. You are watching that shift now, quietly, incrementally, relentlessly. Reality check. This is not fear-mongering. This is pattern recognition. Every inflationary decade begins the same way, with denial dressed as control, and everyone ends the same way. With reality enforcing discipline, the system refused to apply itself. The 1970s were not an accident. They were a consequence, and consequences do not disappear just because technology improved. They compound. The hidden mechanism, how paper markets replaced reality. By the late 1970s, inflation wasn't just visible in prices, it was visible in behavior. People stopped trusting numbers. They stopped trusting timelines. They stopped trusting institutions. That loss of trust did not happen because inflation existed. It happened because people realized the system was hiding it. And this is where the story becomes uncomfortable. Because the same hiding mechanism is operating right now, only larger, more complex, and far more fragile. The Great Substitution. After the chaos of the 1970s, policymakers reached a quiet consensus. They would never again allow raw price signals to expose systemic weakness. Instead, they engineered a substitute, paper claims. Futures markets expanded beyond hedging. Derivatives turned risk into a product. Swaps allowed liabilities to be masked. ETFs created the illusion of ownership without delivery. This was not accidental, it was architecture. The goal was simple: absorb inflation pressure into financial complexity before it could spill into public panic. For decades it worked, but every layer of abstraction added one fatal vulnerability: leverage without physical backing. COMEX futures and the illusion of abundance. Let's talk about metals because this is where the mechanism is easiest to see. On paper, the silver market looks deep, liquid, and well supplied. Daily trading volumes suggest enormous availability. Price movements appear orderly, but that picture collapses the moment you ask one question: how much of that silver actually exists, unencumbered, and ready for delivery? The answer is uncomfortable. COMEX inventories are reported in categories: Registered, eligible, pledged, leased, swapped, rehypothecated. The same ounce can support multiple claims. This is not theory. It is disclosed in filings, quietly, technically, legally. And as long as most participants settle in cash or roll contracts, the system remains stable. But stability here is conditional. It depends on behavior never changing. ETFs, exposure without ownership. ETFs were sold as democratization, access to metals without storage, liquidity without friction, exposure without complexity. But ETFs introduced a new risk. One few investors understand. They are not vaults. They are structures. Their metal can be leased. Their custodians can use sub-custodians. Their inventories can be pledged. Ownership is indirect, and indirect ownership behaves very differently during stress. In the 1970s, physical demand overwhelmed futures markets. In 2025, ETFs sit between investors and reality, delaying recognition, not eliminating it. That delay is dangerous, because when confidence breaks, the exit is not orderly. Basel rules and the incentive problem. After 2008, regulators claimed they were reducing risk. In practice, they redistributed it. Basel rules reclassified assets. Certain sovereign bonds became risk-free. Certain paper instruments required minimal capital backing. This encouraged accumulation. Banks loaded up on government debt. Leverage increased quietly. Balance sheets grew heavier, but looked safer on paper. Inflation changed that math. As yields rose, bond prices fell. Losses emerged, unrealized but real. Liquidity became sensitive, and suddenly the assets meant to stabilize the system became pressure points. This is not a coincidence. It is the consequence of confusing regulatory treatment with economic reality. Liquidity is not supply. Here is a reality check the system avoids admitting. Liquidity can be created instantly. Supply cannot. You can inject trillions into markets overnight. You cannot conjure commodities, energy, labor, or infrastructure. During the 1970s, this mismatch revealed itself brutally. In 2025, it is worse, because globalization once masked scarcity. That mask is gone. Supply chains are fragile. Energy is geopolitical. Food is climate sensitive. Labor is demographic. And yet paper markets still price abundance. That gap is inflation. The 2025 stress signals now bring this machinery into the present. By late 2024, delivery ratios in certain commodity markets began to rise. Industrial users increased forward purchases. Governments quietly stockpiled strategic materials. At the same time, futures curves remain calm. That divergence matters. It tells you physical demand is no longer trusting paper assurances. This is the same behavioral shift seen in the late 1970s, when contracts were no longer enough. Add to this weakening treasury demand, rising refinancing costs, and banks sitting on bond portfolios that only work if yields cooperate. The system is being squeezed from both sides, scarcity on one end, debt on the other. Why price is still contained, for now? If this pressure is real, why hasn't everything exploded yet? Because intervention has become sophisticated. Central banks don't just raise or cut rates anymore. They manage expectations. They influence curves. They coordinate liquidity. They buy time. But time is not neutral. Every delay allows leverage to grow. Every suppression hardens future moves. Every intervention increases eventual volatility. In the 1970s, policymakers underestimated this dynamic. In 2025, they understand it, but cannot escape it. The confidence threshold. There is a line every system depends on. The moment participants stop believing that paper claims will always convert into real value. Cross that line, and behavior changes instantly. Hedging becomes hoarding. Exposure becomes extraction. Liquidity becomes flight. The system doesn't collapse slowly after that. It reprices violently. This is why authorities fear delivery pressure more than speculation. Why they fear hoarding more than inflation prints. Why they fear trust erosion above all else. Because once confidence cracks, no model can contain it. Reality. Check you are not watching random volatility. You are watching a structure strain under assumptions that no longer hold. The paper markets were designed to smooth reality, not replace it. And in 2025, reality is pushing back. Hard, the trap, and the mathematics of the endgame. Every financial system fails the same way. Not from one shock, not from one bad decision, but from a narrowing corridor of choices until none remain. By 2025, that corridor is almost gone. The illusion of control still exists. The language of stability still dominates headlines. But underneath, the structure is cornered by math, not opinion. And math does not negotiate. The trap has closed. The modern system is trapped between four forces, all pulling in opposite directions. If rates rise meaningfully, debt servicing costs explode. Governments cannot refinance cheaply. Corporations face margin compression. Banks realize losses they cannot hide. If rates stay suppressed, inflation erodes purchasing power faster than wages can adjust. Confidence weakens. Hard assets decouple from paper pricing. If liquidity is withdrawn, markets seize. Credit freezes. Risk assets collapse simultaneously. If liquidity is injected, scarcity pricing accelerates. Currency credibility deteriorates. Every option breaks something. This is not a policy dilemma. It is a structural dead end. In the 1970s, policymakers eventually chose pain. Rates went high enough to crush inflation, but only because debt levels allowed it. In 2025, that option no longer exists. The system is too leveraged, too interconnected, too politically constrained. So inflation is not being defeated. It is being managed. And managed inflation always ends the same way. The point of no return. There is a moment in every inflationary cycle when behavior changes permanently. People stop planning long-term. They stop trusting fixed returns. They stop believing official narratives. In the late 1970s, this manifested as hoarding, wage spirals, and asset substitution. In 2025, it manifests differently, but the psychology is identical. Long-duration bonds lose appeal. Cash becomes a melting asset. Real goods take precedence over promises. This is why delivery matters more than price. Because once participants prefer possession over paper, the system loses its final stabilizer. The unwinding has already begun. Look closely at what's happening beneath the surface. Banks are quietly reducing duration risk. Institutions are shortening timelines. Governments are issuing more short-term debt. These are not signs of confidence. They are signs of adaptation. Adaptation means acknowledgement, and acknowledgement means the old model is no longer trusted, even by those who built it. This is exactly what happened in the late 1970s before rates exploded. But today, rates cannot explode without detonating the system itself, which leaves only one path. Inflation must do the work. The mathematics of the endgame. This is where speculation ends and arithmetic begins. Debt grows at a compounding rate. Productivity grows linearly. Inflation fills the gap. Scenario 1 is containment. Inflation remains above historical targets, but below crisis levels. Purchasing power erodes quietly. Living standards decline without a headline collapse. This is the slow bleed, the early to mid-1970s replayed. Scenario 2 is confidence erosion. Bond markets demand higher compensation. Currencies weaken against real assets. Price controls and interventions increase. Volatility becomes structural. This mirrors the late 1970s, when credibility broke before policy did. Scenario 3 is rupture, a failed auction, a delivery failure, a currency shock, a sudden repricing of debt against scarce assets. This is not gradual, it is violent, and it is always explained after it happens. Time is the only variable people ask when. That question misunderstands the process. This is not a scheduled event, it is a pressure system. Every delay increases stored energy. Every intervention raises stakes. Every denial accelerates the eventual adjustment. In the 1970s, it took a decade to resolve because the system could absorb pain. In 2025, the system absorbs nothing. It transfers. And transfers always end with someone holding the loss. The generational pattern, every generation believes it is smarter than the last. More data, better models, faster communication. But no generation escapes mathematics. The 1970s generation learned that money without discipline eventually demands payment. This generation is learning the same lesson, only with more zeros attached. History does not repeat because people are foolish. It repeats because incentives do not change. The final reality check, inflation, is not a policy error. It is the consequence of postponing reality. The playbook never disappeared. It was just archived. And in 2025, it has been reopened. Page by page, step by step. The question is not whether the ending arrives. The question is how much trust is left when it does. If this series helped you see what others refuse to look at, if you now understand why the system feels stable right before it doesn't, then like this video and subscribe to Financial Insights, because the most dangerous moments in financial history are never announced. They are lived. And by the time everyone agrees on what happened, the price has already been paid.